Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm your host, Dominic Chu. From conflict in the Middle East to continuing turmoil surrounding tariff policies, should investors reassess the recent outperformance of international markets, specifically maybe even emerging ones? Join me now for the conversation are Malcolm Dorson, head of active investment team and senior emerging markets portfolio manager at Global X Funds, alongside Cinthia Murphy, director of research over at VettaFi. Thank you both for being here with us right now. Malcolm, I'm going to start with you because this is kind of like Law and Order style, ripped from the headlines, right? The weekend was wrought with headlines, and not in a good way, surrounding geopolitical risk. The U.S. and Israel have made a conflict with Iran even more on the front burner now with attacks there, and the subsequent retaliation by Iran against assets throughout the Middle East. I guess my big picture question to start things off is, Malcolm, has this changed the landscape for global investing?
Dom, thanks for the question. You're right. It's been a busy weekend filled with headlines. That said, I think it was pretty well telegraphed. If we looked at names moving on Thursday, Friday, Middle East names were down 4 or 5%. Energy was up. Market was starting to expect this. And for context, the Middle East represents only about 5% of emerging markets. So yes, of course, with shorter-term higher oil prices, you have a few different views. You might make a few tactical changes. But big picture, what does this mean from my perspective? It means more uncertainty from the U.S. It means more spending out of the U.S. and ultimately probably fuel to fire in terms of that weaker dollar, stronger EM equity trade. So we think it might be time to double down.
Even if we've seen things moving the way that they have in terms of the dollar strength, which has been a big thesis, right? The dollar strength had been a big proponent or the reason why the U.S. trade was so good. We've seen the dollar decline more medium term over the course of the last year or so, which has been a tailwind, right, for many of these kind of emerging market type use cases. Does this near-term dollar strength on the heels of the conflict change at all what your calculus is?
If the conflict lasts longer and longer than expected, for sure. If this turns into higher oil, higher inflation, higher interest rates in the U.S. leading to a stronger dollar, that could certainly be a headwind. It's not our base case. If anything, you've seen things start to revert already. Overnight, people were saying oil's going to open up 10% higher. It's about 5 and change percent higher now. People are already pricing in what's next. A lot of people are trying to say this is going to be over in a week or two. We're not sure. However, I do think there are a lot of reasons to take advantage to buy the dip here.
All right, Cinthia, you've seen some of the price action so far today with regard to how things have reversed course. Whether or not that stays that way going into the closing bell today remains to be seen. We don't have crystal balls. But has anything about today's price action, the kind of deeper losses that we saw in the futures markets pre-market, to this turnaround where we've actually seen the NASDAQ and the S&P get into positive territory? That's a big reversal. What does that say to you about where investor sentiment is, even with the heightened risk of geopolitical conflict?
Actually, Dom, I think if we think about where we were last year, we start to get used to the concept of geopolitical heat. It's what put the defense theme so in focus starting last year. So maybe it tells me that we've already kind of grown accustomed to a little bit of geopolitical noise. And unless, to Malcolm's point, this proves to be a really lengthy conflict, we are kind of ready to just roll over and keep moving business as usual as much as we can, because that risk is already kind of built into the market.
How do you think, Cinthia, you mentioned the markets and their reaction to this because we've kind of seen this play out before. How much do you think investors are becoming more sophisticated or even more seasoned? Perhaps that's the best way to look at this, that they've seen this kind of story play out before and they've seen it resolve itself. But now those resolutions, whether they're the bounce backs that are more V-shaped in recovery, even those V-shaped ones seem to be happening a lot faster than they have in the past over the course of the past 10 or 20 years. What does that say to you about just where the investor kind of sentiment is right now, and then how they've used prior experiences and history to kind of color their decisions in this moment?
So coming into this year, we actually did a survey with advisors and asked, where do you want to put money to work in 2026? Despite everything that we've been talking about, uncertainty, tariffs, geopolitical tensions, and over 75% said equity risk. So I think that appetite for risk remains dominant, and we're looking for those opportunities. Number two is that we've seen a lot of broadening diversification into things like thematic exposure. So if you think of the conflict this weekend and the focus on, the defense opportunity, how many folks are already invested in that? We've seen that started to happen last year. So I think this broadening of the diversification we've been seeing the last year, we're seeing it now. Folks aren't so reactive because they feel like they're already well positioned for some of these opportunities in the market.
Malcolm, you're a portfolio manager, which means that you have to pay attention often to these types of developments, and you have to figure out whether or not these types of developments warrant significant changes in view, significant readjustments to your investment models or theses. I wonder, from your perspective, Cinthia mentioned the kind of risk-taking mentality we have. Are these opportunities ones that we have to look a little bit more, be more discerning about, I guess is the best way to put it? These international type markets, these emerging markets in particular, are they ones that require more homework on your part to make sure that you are finding the best available opportunities?
I think so, for sure, Dom. And it's not only on my part, it's in the position of broader allocators. If you look at the index within emerging markets, it's still roughly 80% Asia, close to 30% China, and then number two or number three, looking at huge exposures to Korea and Taiwan, which have done really well recently, but that gives you a lot of concentration risk. These are importers of energy as a whole. So I think big picture, people are looking for smaller pockets, either active strategies or single country strategies, and they're trying to figure out what's next. A lot of allocators have exposure to technology, to growth, and they're looking for a more barbelled approach. So they're looking for more value, more cyclicality, and they're finding it in Latin America. So I think that's one area where we're really doubling down on. Countries like Argentina, we have a strategy there, the ticker's ARGT, Brazil, the ticker's BRAZ, and Colombia as well. These countries are checking the box in terms of value, high single-digit PE multiples, growth, exposure to commodities, and carry. So put that all together, you have this exposure to what's going to do well with the elevated commodity prices without the geopolitical risk, and it's a really interesting place to be.
How much of that is specifically a kind of purer play on a relative basis on that kind of commodity trade that we are seeing right now? Are there, when you look at, say, investing in an Argentina, Brazil and Colombia even more so, kind of resource-heavy countries that are dependent on the cyclicality around commodities and their prices, are those mostly the types of companies that you are finding in a LATAM strategy? Or are there other types of names that show up that may be surprising for investors out there investing in a place like Brazil, Colombia, or Argentina?
It's an important part of the story, but it's not it. I'd say 25 to 33% of the story should be that attractiveness of getting exposure to commodities. But Latin America as a whole has a fantastic reform story behind it right now from a political perspective. 2 years ago, we saw Javier Milei in Argentina kind of take over from Peronism and Kirchnerism, really bringing the political pendulum back to the center right. A lot of people think that Colombia could be Argentina 2.0 in the forthcoming elections we're having in May. Brazil has elections this coming October, and all eyes are on political change that could drive fiscal reform, reducing risk premiums, and more flows into these countries. So politics is the other part. The other part is just valuations. You're getting dividend yields 6-7%, PE multiples at a 50% discount to the S&P. And in addition to that, carry. Brazil overnight rates are at 15% with inflation around 4.5%. So one of the most positive real rate environments in the world, giving you stability from a currency perspective.
How do you juxtapose that with the Asian emerging market trade, which is not as tilted in many of those markets like Korea, Taiwan, elsewhere, towards the commodity story, and maybe more levered towards the technology, or dare I even say the AI story these days? How exactly, from an emerging markets portfolio manager's perspective, then do you kind of allocate or pick or discern where the fundamentals may be relatively more attractive in a place that is more geared towards things like the tech and AI trade or more resource-dependent type stories?
I think you need to have both. I mean, we've already kind of covered Latin America. That's giving you diversification. It's giving you exposure to an under-owned part of the world. But Korea, Taiwan, the tailwinds behind the companies that we're seeing there are very strong. It's not just AI as a whole, it's the AI ecosystem. So whether it's the memory cycle, whether it's semiconductors, and top that all off with sort of capital market reforms that we're seeing in Korea with heavily discounted prices compared to what's already worked in the US, people are very interested. So we're using a barbell approach to have both sides overweight. But I think what's overlooked is very interesting are countries such as India, which was really just a gem of a market up until last year for the previous 5 years. It was a market laggard last year. It's come into the year underperforming by about for the first 2 months of the year this year. But if you see what's happening with India, GDP growth is at 7.8%. Inflation rates, low single digits. The central bank's cutting rates. Fiscal stimulus is strong. You have a very market-friendly government. And these elevated gold prices, 20+% of household savings lie in gold in India. So consumer confidence is through the roof. And I think right now, India is a really interesting overlooked place to see.
Now, Cinthia, from your perspective, you track a lot of the flows that kind of move around these ETF markets. Does some of what Malcolm is saying kind of reconcile with what you're seeing from an activity perspective in terms of where investors are actually putting their money or where the flows are kind of the hottest, so to speak? And what can you glean from where those flows are that tell you that maybe international, global, and emerging market story is going to still be intact for a while?
So there is no question that international has been the flavor of the year. When you look at ETF flows, you look at top 20, over 40% of flows have gone into international ETFs. Emerging markets especially have been leading the charge there. It's a percentage amount we haven't seen in many, many years. So international equities have been the biggest opportunity we've seen folks time money to this year. I think it would be interesting to see, maybe this conflict won't last and it won't change that dynamic. But if it lasts, it could put this trade into question because, the U.S. tends to be a strong hedge in a conflict situation. It tends to be a stronger place to put your money to work. So I'll be curious to see if this trend holds, if there's a conflict that's ongoing. And I think the energy play would be really interesting because energy is a big part of the commodities heavy story. It's part of the international European markets are super dependent on energy and oil coming out of the Middle East. So I think it could really shake things up a lot. And I think on the energy, I'm really curious to see if folks are going to target, say, an oil fund like USO and get that immediate impact on the price there. If they're going to go for an energy equity like an XLE and just play that equity side and just take the equity risk, or if they're going to go to something like AMLP, which is your MLPs, your pipelines, which is a more stable, lower vol play that gives you an 8% yield. So I'm curious to see how folks are going to play this energy story in the context of international conflict.
All right. So, Malcolm, with that in mind, if you look at the way things are playing out within that ETF world, there's been a huge, huge movement over the course of the last few years, markedly so, but arguably maybe the last 7 to 10 years. This kind of move towards actively managed ETFs, fund strategies, versus some of the passive index-seeking ones. Cinthia mentioned some of the ways to play these themes with more passive or, price-based, exchange-traded products that track things like the commodity markets. There's also active management when it comes to things like international investing in emerging markets in particular. What exactly is going to be, you think, the big driving force behind that EM trade? Will it be people just seeking index exposure, or those who turn the picking aspect over to portfolio managers to actually kind of try to achieve superior returns?
I think it's both. I think some people are doing it tactically from a passive perspective, but when they do so, they're doing it in a very targeted manner. So going to specific countries, whether it's, okay, I see what's happening in Venezuela, potential regime change. It's a sanctioned country, I can't invest, I need a proxy, so they're buying Colombia. Whether it be playing an election, as they did with Argentina a couple of years ago, as they did with the midterms just a few months ago, or what they might do in Brazil in a few months from now. So big picture, I think that many allocators are targeting from a passive perspective. But when you're looking at your long-term exposure of what's going to be in your broad core asset allocation, most investors don't have the capacity to follow what's going on in the 27 different countries, currencies, political systems across emerging markets. So they want to trust an active manager. So that's the type of appetite we get in our EMX China strategy, EMM. People coming to us saying, please monitor this sleeve of the portfolio for us. Tell me when to be overweight China, when to be underweight China. And now you can do it in an ETF. You get the benefits of the tax structure, the lower fees, the transparency, potential tax efficiencies, and much more of that wrapper. So that's the popularity really is gaining steam.
Now, if I could follow up, Malcolm, you mentioned some of the kind of outperformance that you are forecasting for the LATAM trade in comparison to other parts of the world. Are there certain specific types of companies that you're paying close attention to with regard to where you think there might be future outsized returns? Are you looking more towards, people talk about factors like momentum and growth. They talk about value, you know, dividend yields and that sort of thing. What factors are you the most focused on, and what types of companies do you think? Are you value shopping for some of these names now, or do you feel as though some of the names that have had momentum, that have stalled out a bit recently, still can resume that momentum again?
Yeah, we're a little more cautious on the momentum trades, on the big semiconductor trades, on the memory names that we're seeing out of Korea and Taiwan. A little bit more leaning more towards value, more towards cyclicals, whether that be across commodities. Within commodities, we like copper, we like energy, and we like gold. But I'd say our biggest overweight from a sector perspective is going to be in financials. Financials, so I mentioned Latin America, this potential rate cutting opportunity with extremely high positive real rates. So as rates start coming down, net interest expenses are going to come up across the board. But for financials, you're going to see improved asset quality, people borrowing more, capital market activity really picking up. So we think that's a sweet spot within Latin America.
And Cinthia, before we let you go, what exactly do you think is going to be the thing that you're going to be watching most closely for in the next, say, 3 to 6 months, given the fact that we've seen tariffs kind of evolve and get re-upped? We've seen political developments on our side here in the United States, and now we've seen geopolitical risks emerge in the Middle East yet again. What do you think is going to play out for these fund investors in the ETF business as things shake out for 2026?
Yeah, I think we've seen from a factor perspective, quality work really well, not only deliver, but also investors really flock to quality as kind of your defense play. I mean, the trick is quality's gotten a little expensive because, you know, most of Mag 7 companies fell into that quality bucket. So you have to be valuation aware. But when we look at ETFs that have really delivered on the active management space, to your point, Dom, you know, funds from like Avantis and Capital Group, they focus on that quality, but they're very valuation aware. So anytime you're blending those things together, it has worked really well. We're going to be looking for that space to continue to do well. And we'll be watching this international trade. I've been fascinated by it in the last 18 months or so. And I want to see how far it goes. It's been exciting to see folks diversify from that, you know, US-centric exposure. And we'll see what the latest news does to that play. So I'll be watching that trade.
All right. Well, Malcolm and Cinthia, thank you both very much for joining us for this conversation. We really appreciate it. Now, we've asked Cinthia to stick around for the ETF Edge podcast. You can catch that and all of our other content over at etfedge.cnbc.com. Thanks for watching, and we'll see you next week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.